Hi, I'm Siu-Ling Hui with part 6 of a video series about the cash flow statement. In this video, we will look at the use of the bank balance section of the cash flow statement in business reviews and in strategic planning. The bank balance section shows the net cash flow impact of all of your operating, investment and financing activities on your cash balances. The layout of the bank balance section for actual or historical accounts is different from when you do forecasts because you are using your numbers from a different perspective when you do a review of actual business results versus strategic planning for the future. Let's start with historical accounts. In business reviews, the cash flow statement shows you what happened with your money, what activities in your business used up or generated cash, and the bank account section shows you if your accounts are correct. Does your profit and loss tie in with your balance sheet? You wouldn't want to drive a car that had unreliable instruments on the dashboard, so why would you make business decisions based on incorrect information? Here's how I set up the bank balance section to provide this reliability check when I'm reviewing historical accounts. You should be reviewing your accounts every month, so I'm going to talk about this in monthly terms, but this works the same way for any business review period. The actual bank account balances are taken from the balance sheet. You know how much your bank account actually went up or down by each month. The change in your bank balance in a month should be exactly equal to the net cash flow for the month. In other words, there should be zero difference between the net cash flow and the change in bank balance for that month. Think about it. If your business had positive net cash flow of $1,000 in January, then your bank balances must have increased by $1,000 during the month. The net cash flow figure is derived from the profit and loss and the balance sheet numbers. If there's a difference between the net cash flow and the change in bank balance figure, like in these made up numbers for February, that means there are errors in your profit and loss or your balance sheet or both. You'll be surprised how often these discrepancies show up in a review. It's critical that you have reliable numbers for decision making, so always include the cash flow statement in your business review, and if there are any discrepancies, find out why. One of the common causes of this discrepancy is straight out flawed accounting. This is why it's really important to have a good accountant or bookkeeper for your business. Think of the money spent on this vital service as an investment into your business, not just a cost that you skimp on. Another common cause of discrepancy is changing the numbers in prior period accounts. For example, making changes to January profit and loss numbers in April. Going back and changing numbers in previous accounting periods is bad business practice. It's like changing the score in the first quarter of a game when you are in the third quarter. You won't know where your business is really at. How can you make properly informed business decisions based on shifting numbers? It also increases opportunity for fraud. How are you going to know if someone is cooking the books and embezzling funds if your numbers keep moving? A final note, just because there's no discrepancy in the bank balance section of the cash flow statement doesn't guarantee that the accounts are reliable. There are many sophisticated ways of manipulating the accounts. The key is to get a very good feel of your numbers so you will smell a rat as soon as weird stuff starts happening. Now let's take a look at how you use the bank balance section of the cash flow statement for budgeting or strategic planning. Forecasting is an iterative process. The first cut of the forecast allows you to understand the cash flow implications of your business strategies. The bank balances section of the forecast cash flow statement of this first cut will show you what financing you potentially need to achieve your business strategies. Then you decide your financing strategies, plug the proposed financing amounts into the forecast, and assess the updated forecast. Do you need to make changes to your business or financing strategies? The layout of the bank balances section in the forecast cash flow statement is pretty simple. Your forecast net cash flow feeds into the bank balance section and gives you the projected closing bank balances in the forecast period. Negative bank balances means you will need additional financing to achieve your business objectives. The largest negative bank balance in the forecast period will be the expected peak funding requirement. What type of business activities require funding? This is important for working out the right type of financing for your business. Also, lenders or investors will want to know the purpose that you're going to be using their money for. Is it operational activities or capital expenditure or both that will require financing? Will financial commitments like interest payments or scheduled repayments of borrowings put stress on your forecast cash position? Once you determine what financing strategies are appropriate, you slot the financing amounts as cash inflows into the Finance Activities section so that you end up with positive closing cash balances. Will these revised bank balances give you an adequate cash buffer if things don't happen in line with the assumptions underlying your forecast? If you have or intend to get an overdraft facility, you would include it in the bank balance section of the forecast cash flow statement instead of the financing section. This is because an overdraft works like a spare petrol tank for your bank account. It automatically funds payments if your bank account is empty. Here's an example of the bank balance section of the forecast cash flow statement that includes an overdraft facility. If net cash flow for the month results in a negative bank balance, the shortfall is funded from the overdraft. Positive cash balances go immediately towards repaying the overdraft, but the amount of the repayment must not cause the closing bank balance to become negative. The aim here is to identify the potential usage of your overdraft facility and whether you will potentially exceed your overdraft limit as a result of your business growth strategies. Should you get an increase in your overdraft limit to meet your financing requirements? Or should you get other types of financing so that you do not run close to your overdraft limit all the time? Note that the forecast cash flow statement shows end-of-month bank balances and end-of-month overdraft balances. You should also be doing rolling weekly cash flow forecasts to identify any potential intra-month funding needs. Once the proposed financing is incorporated into the forecast, you should assess the implications on your business. Your forecast should be in the form of three-way statements so that you get a three-dimensional view of your business. New financing will feed in through the forecast balance sheet. What does the financial position of your business look like? Can you afford to take on more debt, or should you be thinking about raising equity? What will any additional interest cost do to your profitability? What will it do to your cash flow? What kind of repayment program can you afford to commit to? What would your business look like if the underlying assumptions in your forecast changed? If you want more information about any aspect of the cash flow statement or financing in general, please put your questions below in the comments or contact me through the contact page at incontextfinance.com. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.